Welcome back to the Global Ledger. I'm Justin. In the last episode, we walked through the anatomy of a modern financial crisis. Not as history, but as a system under stress. We trace how liquidity breaks, how balance sheets bind, and how funding failures propagate long before prices collapse. Today, we're going to do something equally important. We're going to take everything we've learned, liquidity, funding, balance sheets, dollar dependence, crisis mechanics, and apply it directly to valuation. Because here's the truth. Most valuation frameworks assume the financial system always works. This episode is about what changes when it doesn't. Let's get into it. Traditional valuation focuses on a couple things. Those are cash flows, growth rates, margins, discount rates, okay? All which are useful. But they typically ignore how those cash flows are funded, what currency risk sits underneath them, and whether the firm can survive a funding shock, even if its business model is sound. This is why in every crisis, cheap companies fail. Safe balance sheets aren't. And why valuations break suddenly, not gradual. Valuation errors are rarely about the math. They're about missing the system. For this episode, imagine a representative global firm for a second. Okay, revenue across multiple continents, costs in several currencies, debt issued in US dollars, reliance on global banking relationships, and exposure to trade finance, FX hedging, and capital markets. Okay, and if those things I just mentioned are still cloudy and confusing, do not worry. If you continue to watch the series, I promise you will understand it. It's just going to take some time. That's it. So don't fret. And we will be building this to where you can go back and watch videos of me on camera explaining what each of these items are. We've just started the channel, so it's a little difficult to have all that at once, but I promise it will be there, and I will be here too. So, got off track there a little bit, but basically, this is not a niche case, okay? This is really the modern multinational, okay? When basically those things that I mentioned, as far as what a global firm would look like today. So the question with this is not, is the business good? The question is, can it survive a system-wide funding event? Okay, so keep this in mind. So most models treat currency exposure as a footnote, okay? But currency mismatch is one of the fastest ways a healthy company becomes fragile. By the way, the first adjustment here, currency is not neutral. Okay, so key questions with this. This is what we're talking about, currency. Ask these questions. What currency are revenues earned in? What currency is debt serviced in? And what happens when FX funding markets freeze? So, as an example, in March 2020, companies didn't fail because demand vanished overnight. They failed because dollar funding became scarce. A system-aware valuation explicitly prices FX funding risk, hedging continuity risk, and rollover risk under stress. That's currency. Okay, the balance sheet now is not static. In textbooks, this is big. Okay, balance sheets are snapshots. In reality, they are dynamic under stress. During liquidity shocks, credit lines get drawn, margins get called, collateral requirements rise, refinancing windows start to shut. Okay, a valuation that assumes normal access to funding is making a heroic assumption, in my opinion. So, our system-aware valuation approach here asks, how quickly does leverage rise under stress? How dependent is the firm on short-term funding? And who controls its access to liquidity? These questions matter more than beta. Discount rates now. Okay, discount rates are not just macro variables. Most discount rates are built from risk-free rate, okay, equity risk premium, and company-specific adjustments. But the risk-free rate is not free during crises. In stress events, funding costs decouple from policy rates. Spreads matter more than benchmarks, and liquidity premia dominate risk premia. And our system-aware discount rate reflects funding fragility, refinancing dependency, and exposure to dealer balance sheets. Very important. This is why discount rates jump before earnings start to collapse. This may be a little controversial, but I've got a part in this that I want to talk about, which is the illusion of diversification. Geographic diversification is often treated as a stabilizer, but in global crisis, correlations go 2-1 through funding channels. Okay? A firm operating in 10 countries but funded in one currency is not diversified. System-aware valuation treats global exposure as a conduit, not a hedge. Okay? Dollar dependence as a structural risk, and international banking links as transmission lines. Very important. Let's talk about stress testing the valuation. In our system-aware valuation, we always ask, okay, what happens if funding markets cease for 90 days? Or FX hedges become expensive or unavailable? Or dealers reduce balance sheet capacity? Or capital markets close temporarily? This doesn't require forecasting as a crisis. It requires acknowledging the possibility. That's it. If a valuation collapses under mild system stress, it was never robust to begin with. So why does this matter for investors and policies? Okay, this framework explains why crises reprice assets faster than fundamentals. Okay, why cheap stocks fail in liquidity events, and why policy backstops move markets instantly. Markets don't wait for earnings reports. They respond to funding conditions. Valuation that ignores the system explains the past poorly and predicts the future badly. Now that we've applied a system-aware lens to valuation, the next step, I think, is unavoidable. Okay? That is, why do policymakers keep getting crises wrong, even after living through them? In episode 98, we're going to examine what policymakers get wrong repeatedly, because misdiagnosing crises leads to repeated mistakes and repeated instability. And that's next. Thank you for listening to episode 97 of the Global Ledger. We're very close to reaching our 100th episode, and I'll make an announcement at the 100th episode about what to expect next. But once again, I'm Justin, and thank you for being here.